Okay, so I want you to imagine that you run a restaurant, like a highly successful, totally booked up restaurant.
Right, the kind where you literally can't get a table on a weekend.
Exactly, and it's a Friday night. Normally you serve, 200 people on a Friday.
Yeah, wall-to-wall packed.
But tonight, for whatever reason, you only serve 150. Your dining room is a solid 25% empty.
Which, in the restaurant business, usually means you are panicking.
Right. By all traditional metrics, you should be completely freaking out. But then, at the end of the night, you sit down to count the till.
Let me guess. The numbers don't match the empty room.
Not at all. You realize you actually walked away with 17% more cash in your pocket than when the place was packed to the gills.
Which sounds mathematically impossible until you look at the menu.
Precisely. Because tonight, you didn't sell a single $10 burger. You only sold $50 premium steaks.
That's such a perfect analogy for what we're looking at today.
It really is. So, welcome to today's deep dive, everyone. We are looking at the Q2 2026 earnings call for Ford Motor Company.
Ticker symbol F for those following along in their brokerage account.
Yep, ticker symbol F. And, while we'll be using a pretty structured framework today, looking at the headline numbers, the story behind them, management's guidance, and the bottom line, we are bringing our usual depth to this.
We really need to, because this isn't just a standard earnings call.
No, not at all. We are going to spend the next hour unpacking exactly what this specific call reveals about a massive high-stakes transformation.
A transformation that's basically rewiring the entire global auto and tech landscape right now.
Yeah, the stakes are just incredibly high. And earnings calls can sometimes sound like absolute alphabet soup. But this one, it is a goldmine of surprising pivots.
It really is a fascinating quarter to dissect. Because that restaurant analogy you just used, it is exactly what is happening at Ford right now.
Literally exactly the same dynamic.
Yeah, the defining characteristic of this entire quarter is this massive core contradiction. Ford fundamentally made more money, but they manufactured and sold fewer cars.
Which challenges basically everything we've ever assumed about how car companies work.
Exactly. Historically, the automotive industry has been a game won and lost entirely on sheer volume. Keep the assembly lines moving at all costs.
Right. Pump out the sedans, flood the dealership lots, and figure out the margins later. But they are completely pivoting away from that.
They are. And the financial reality check here is where the story really starts.
Okay, let's unpack this because we need to do some translation for the folks listening. Let's look at the top line headline numbers first.
Sure. Lay them out.
So in Q2 of 2026, Ford generated $48.3 billion in revenue.
Which is a massive number on its own.
It is, but on the surface, that's actually a 4% drop year over year.
Right. And as an investor, your initial reaction to a revenue drop is usually pretty negative. You start sweating a bit.
Exactly. You see revenue go down and you assume the sky is falling. But then you look at the profitability metrics.
And that is where the entire narrative of this quarter flips upside down.
So can you walk us through what actually happened on the bottom line?
Absolutely. So we need to look at adjusted EBIT. That's EBIT.
Earnings before interest and taxes, right?
You got it. It's basically the pure profit generated from their actual operations. It strips out all the complex debt and tax structures that the accountants handle.
It's just the raw operational money-making engine of the company.
Exactly. And their adjusted EBIT came in at $2.5 billion for the quarter.
Which is wild because that is a 17% increase year over year.
Right. So to recap that for everyone listening, revenue is down 4%, but operating profit is up 17%.
The premium stakes.
Exactly, the premium stakes. And furthermore, their adjusted free cash flow, which is the actual tangible cash they generated that can be used for dividends or reinvesting, was incredibly robust.
Wait, what was the number on that?
It came in at $2.1 billion.
Okay, wow. But we do have to address the elephant in the room here. Because if you were just glancing at the absolute headline net income on Yahoo Finance or something.
Oh yeah, the net income number looks terrifying at first glance.
It really does. You see a $1.3 billion net loss in the quarter.
Yeah, a billion plus loss is hard to ignore.
It is. But the earnings report notes this was driven by a $3.6 billion special item charge. And that was related to the Blue Oval SK battery joint venture.
Right.
So what exactly happened there? Because, I mean, a $3 billion hit is still real money, even if Wall Street calls it a special item.
It is real money, but it is a reflection of past decisions. It's not a current operational failure of the business today.
Okay, break that down for me.
So the Blue Oval SK joint venture was this massive battery plant initiative they launched a few years ago. And they launched it when the entire industry expected EV adoption to just be this straight, uninterrupted exponential curve upwards.
Like a rocket ship. Everyone thought we'd all be driving EVs by 2025.
Exactly. But the reality of consumer demand has been much more of a stepped progression. It's slower. So Ford is strategically unwinding or restructuring parts of that specific joint venture to match a more realistic timeline.
Ah, okay. So they are scaling back the battery factories because they don't need all those batteries right this second.
Precisely. And when you do that, strict accounting rules require you to write down the value of those assets. You have to take the pain on the spreadsheet now.
So it's a one-time paper loss. It's not like they had $3 billion in cash actually fly out the door this quarter.
Exactly. It's management essentially clearing the decks of a legacy EV strategy. They are cleaning up the books so they can focus their actual capital on what is working right now.
That makes total sense. It's like taking the bitter medicine now so the long-term balance sheet is healthier going forward.
That's a great way to look at it.
But let's get back to the operational side. That 17% increase in profit. We teased it with the steak analogy earlier, but how exactly is Ford pulling this off?
It's pretty remarkable, isn't it?
It really is, because making more profit on fewer sales goes against literally a century of automotive business models. Henry Ford would be so confused.
He really would. But it comes down to two words that absolutely dominated this earnings call: mix and pricing power.
Mix and pricing power, okay.
Yeah, what we are witnessing is a very deliberate, highly disciplined strategy by Ford. They are leaning intensely into higher margin vehicles over sheer volume.
So they are actively choosing not to build the cheap stuff.
Right. And honestly, the drop in revenue was largely expected. Part of it stemmed from a specific aluminum supply issue we'll discuss in a bit.
Oh, right. The Novellus thing. We'll definitely get to that.
Yeah. And part of the revenue drop was the planned sunsetting of certain older, less profitable vehicles. They're just killing off the low margin models.
So by ensuring that the vehicles they did manufacture and sell were highly optioned premium trims, they squeezed significantly more profit out of a smaller physical footprint.
Exactly. They sold fewer cars, but the ones they did sell were loaded with features.
Which brings us perfectly into the story behind the numbers. I want to focus specifically on the division they call Ford Blue.
Ah, yes, the cash cow.
The ultimate cash cow.
Okay.
So, for you listening, Ford split its business into a few distinct pillars a few years ago. Ford Blue is their internal combustion engine, ICE, and hybrid division.
It's the traditional metal-bending, gas-burning side of the business.
Right. And the revenue here was $26.1 billion, which is practically flat. It's up only 1%.
Right. Nothing to write home about on the top line.
And their wholesale sales, the actual units shipped to dealers, those were actually down 8%.
But the profit?
The profit is insane. The operating profit, the EBIT for Ford Blue, skyrocketed by 72% to $1.1 billion.
It's just staggering.
It really is. That is the premium stake strategy in action, isn't it?
It is the absolute embodiment of it. And what's really fascinating here is the underlying mechanics of how they are achieving that profitable mix.
It's not just luck.
No, it's highly engineered. And it starts with the undisputed king of the hill, the F-Series pickup truck.
Of course. The F-150 basically prints money for them.
It does. It remains the #1 truck brand. In just the first half of 2026, it outsold its closest competitor by 80,000 units.
That is a massive lead for just 6 months.
It is. They're currently pacing to have their 50th straight year as the best-selling truck in America. 50 years.
That's half a century of dominance, but it's crucial to understand that it's not the bare-bones vinyl seat work trucks that are driving this 72% profit jump, right?
Definitely not. The work trucks are steady, but they aren't the profit engines here.
Right. The call highlighted that it's the off-road enthusiast vehicles, the Bronco, the Tremor trims, the F-150 Raptor.
The lifestyle vehicles.
Exactly. Management noted that these high-margin, highly customized off-roaders now make up a staggering 25% of all their U.S. sales.
1 in 4 vehicles sold is an off-road enthusiast model. That's huge.
And that off-road mix grew by over 4 points year over year just in the second quarter. Raptor sales alone are up 9%.
Those Raptors easily push $80,000, $90,000.
Easily. And on the other end of the spectrum, you have the hybrids. The Maverick Hybrid, which is this brilliant, smaller, affordable truck, has literally become America's best-selling hybrid pickup.
It's incredibly popular. You can barely find them on lots.
It's genuinely surprising to me to see the massive staying power of the traditional V8 engine and off-road capability in 2026, living perfectly alongside this massive hybrid boom.
It proves that consumers are willing to pay a really heavy premium for specific utility and lifestyle signaling.
Lifestyle signaling, that's a good way to put it.
Yeah, because an F-150 Raptor isn't just transportation.
Yeah.
It's a lifestyle product. And the margins on a lifestyle product are exponentially higher than on a standard commuter sedan.
People want to look cool and they will pay for it.
Exactly. But there's a mechanical reason behind why Ford can maintain those high prices without resorting to massive discounts. And it has to do with how they are managing their inventory.
Okay, here's where it gets really interesting for me, because the earnings call noted that the F-Series is currently sitting at just a 45-day supply of inventory.
Right.
And their historical target is normally 55 to 65 days. To put that in perspective for the listeners, before the pandemic supply chain chaos, automakers used to routinely have 80 or 90 days of vehicles just sitting on asphalt baking in the sun.
Massive lots, just overflowing with inventory.
Exactly. So why is a 45-day supply such a big deal for their bottom line?
Because that lean inventory is not a mistake.
Yeah.
It is a weaponized advantage.
Weaponized inventory. I love that.
It reflects what management calls intense go-to-market discipline. Historically, empty dealership lots absolutely terrified automakers.
Right. They thought if they didn't have 50 blue trucks for a customer to choose from, they'd lose the sale to Chevy or Dodge.
Exactly. But post-pandemic, Ford realized that an overflowing lot actually forces you to discount. When you have 90 days of supply, Ford and its dealers have to put cash on the hood, those massive rebate commercials you see on TV to move the metal.
0% APR and $5,000 cash back.
Right. But at 45 days, you create artificial scarcity.
It's the psychology of FOMO, right? Fear of missing out, but applied to a $70,000 truck.
Exactly. When a customer walks onto a lot and only sees 3 Raptors, the dealer doesn't need to negotiate. The customer pays full MSRP or sometimes even a dealer markup premium.
Because if they don't buy it today, someone else will buy it tomorrow.
Precisely.
Yeah.
And in this quarter, Ford had the lowest incentive spend among its major competitors. They commanded the highest share of revenue.
So they are literally just giving less money away in discounts.
Yep. By maintaining that artificial scarcity, they fiercely protect their premium pricing. That is the fundamental mechanism behind how you achieve a 72% jump in profit on 8% lower wholesale volume.
You essentially train the consumer to expect to pay exactly what the sticker says.
You have to. You break the cycle of discounts.
Okay, so that strategy is clearly working beautifully for the consumer side of the truck business, but no strategy is entirely immune to the physical realities of manufacturing.
No, physics always wins eventually.
Right. Which brings us to the commercial side of the house, Ford Pro.
Ah, Ford Pro.
Yeah.
The workhorse.
Exactly. This division has historically been the absolute commercial engine of the company. It's the transit vans, the heavy-duty fleet trucks, the vehicles that actually build infrastructure and deliver our packages.
It's normally their most reliable profit center.
But Ford Pro hit a major speed bump this quarter. Revenue was $17.8 billion, which is down 5%.
And the profit hit was even harder.
It really was. The EBIT was $1.7 billion, which is a pretty sharp 26% drop from last year.
Ouch.
Yeah. And they explicitly named the culprit on the call. They called it a Novellus aluminum supply disruption.
Yeah, that was a huge talking point.
Year to date, they noted this one single issue has cost Ford $800 million. And they project a full-year impact of $1.5 billion.
It's a staggering amount of money for a materials delay.
Right. And I have to be honest, I'm a bit confused here. How can a single supplier issue, just one specific type of metal, kneecap an entire segment's profit by over a quarter?
It is a really stark reminder of the sheer fragility and interconnectedness of modern automotive supply chains.
Like the butterfly effect, but with aluminum.
Exactly. We tend to think of car manufacturing as just slapping parts together like Lego, but it's highly sequenced choreography. Everything has to arrive exactly on time.
Just-in-time manufacturing.
Right. To understand the aluminum issue, think about trying to build a 50-story skyscraper. You have the glass, the drywall, the elevators, the plumbing. It's all waiting on site.
Sounds like a logistical nightmare.
It is. But then you suddenly realize the supplier forgot to deliver the steel girders for the 3rd floor.
Oh, wow.
Right. It doesn't matter how much glass you have sitting there. The entire project stops dead. You can't put the fourth floor on empty space.
That makes perfect sense.
So when Ford is building a Super Duty truck, they use specialized automotive-grade aluminum for key structural and body components. It saves weight and increases the towing payload.
And Novellus is the supplier making that specific aluminum.
Yes. They're a massive supplier of this specific rolled aluminum. So when they have a disruption, whether it's a mill issue or logistics or whatever, the assembly line has to halt.
Because you can't just run to Home Depot and buy sheet metal.
Exactly. You cannot substitute steel at the last minute. The entire vehicle architecture, the tooling, the stamps, it's all engineered for that exact gauge of aluminum. So thousands of vehicles just sit unfinished on the line.
But are those sales just gone forever? Like if a plumbing company needs 10 Super Duty trucks, do they just cancel the order because of a delay?
That is the crucial question.
Yeah.
And it's why that $1.7 billion in profit is actually a very bullish signal disguised as a bad quarter.
Wait, really? A 26% profit drop is bullish.
Hear me out. Despite a staggering $800 million headwind from a physical supply chain failure, Ford Pro still pulled in nearly $2 billion in pure operating profit.
That is true. They still made a mountain of cash.
Exactly. That proves the underlying demand for commercial fleets is incredibly resilient. Those plumbing companies and construction firms aren't canceling their orders. They're just forced to wait.
So the sales are delayed, not destroyed.
Exactly. The revenue will hit eventually.
Which explains why Ford management was so eager to highlight their fix for this. They are launching a massive expansion at their Oakville assembly plant in Q4 of this year.
Right, to deal with the backlog.
Yeah, they said it will add up to 100,000 units of Super Duty capacity. They are basically building a bigger pressure valve to release all that pent-up fleet demand once the aluminum flows freely again.
It's a smart move to capture that delayed revenue quickly.
Okay, so we have traditional consumer trucks pulling in massive profits through artificial scarcity, and commercial trucks delayed but experiencing ironclad demand. Now, let's pivot to where the anxiety usually lies for investors. Model E.
Model E, the electric vehicle and software division. This is where the narrative requires the most nuance.
It definitely does, because let's state the harsh realities first. Model E lost $919 million in EBIT just this quarter alone.
Yeah. They are essentially setting nearly $1 billion on fire every 90 days.
It's an agonizing cash burn. However, the revenue for the segment actually jumped 31.5% to $1 billion.
Which is a solid growth rate for the top line.
Right. And management was really quick to point out that this actually marks the third consecutive quarter of EBIT improvement for the segment.
The losses are shrinking, basically.
Exactly. They also provided some forward-looking data, noting that their Generation 1 EV costs, the cost to build the Mach-E and the F-150 Lightning, are expected to drop by roughly 40% throughout 2026.
And that transition away from those costly early generation models is totally critical.
Why were those Generation 1 models so expensive to build in the first place?
Well, we have to remember that Generation 1 EVs across the entire legacy auto industry were essentially retrofits.
Like stuffing batteries into a gas car frame.
Kind of, yeah. They were heavily over-engineered, they were rushed to market to prove a concept, and the supply chains for the batteries were deeply inefficient.
So they just threw money at the problem to get them on the road.
Exactly. But by slashing those structural costs by 40%, Ford is aggressively right-sizing those volumes.
But still, that billion-dollar quarterly loss is brutal.
It is. It's the toll they are paying to cross the bridge. The real question for investors is, what is on the other side of that bridge?
And that brings us to the UEV platform arriving next year. The specs management laid out for this vehicle are honestly wild.
They're very aggressive targets.
Yeah, they're targeting a true $30,000 price point. But they claim it will have more interior cabin room than a Toyota RAV4.
Which is a midsize SUV, so that's a lot of space.
Right. It will include a functional pickup bed. It features bi-directional charging, meaning it can literally power your house in an outage, and it will feature native Apple Maps integration.
It sounds like a Swiss Army knife.
It really does. But wait, I have to push back here. They are bleeding $1 billion a quarter right now, making $60,000 EVs.
True.
What makes them think they can suddenly produce a $30,000 Swiss Army knife vehicle without bleeding even more cash?
That's the $1 million question, or the $1 billion question, I guess. Yeah. The answer is that it's an entirely new underlying architecture.
Okay, so they aren't just making a cheaper Mach-E.
No, not at all. The UEV, which stands for Urban Electric Vehicle or Utility Electric Vehicle, they haven't finalized the exact branding yet, is designed from the ground up.
Who designed it?
It was built by a specialized skunkworks team that Ford actually hired away from places like Tesla and Rivian.
Oh, wow. So they brought in the Silicon Valley EV guys.
Exactly. The reason they believe they can target a $30,000 price point profitably is radical simplification.
Fewer parts.
Way fewer parts. Cheaper lithium iron phosphate batteries and a manufacturing process that eliminates literally hours of labor on the assembly line.
Okay, that makes sense. But still.
But to answer your pushback fully, you are right to be skeptical. The hardware margin on a $30,000 vehicle will always be razor thin.
Right. There's just not that much meat on the bone.
Exactly. The secret sauce, the actual reason they are so desperate to get this platform to market, isn't just the sheet metal, it's the screen and the dashboard.
The software.
Yes, the software flywheel.
And the numbers they dropped regarding software on this call were eye-opening. Ford announced they now boast 1.6 million paid software subscriptions across the company.
Paid subscriptions, not free trials.
Right. 900,000 of those are for Ford Pro Intelligence, which is their fleet management software, and 700,000 are retail consumer subscriptions.
Which brings us to Blue Cruise.
Yes, Blue Cruise. Their hands-free autonomous driving platform. Blue Cruise now accounts for 50% of their retail integrated services revenue.
Half of their consumer software revenue is just the self-driving feature.
Yeah, subscriptions for it grew 20% just in Q2, and the platform have logged a staggering 12 million hours and 840 million miles of hands-free driving.
Those numbers are massive.
They are. So are we watching Ford quietly try to transform from a traditional metal bender into a software as a service company?
They're absolutely trying to do exactly that.
Mm-hmm.
The automotive business model has historically been incredibly transactional.
You buy the car, you drive away, see you later.
Right. The company sells you a vehicle, you drive off the lot, and they might see you for an oil change or to buy parts a few years down the line. That's it. The relationship ends at the transaction.
But a software subscription fundamentally alters that dynamic.
It does. Management explicitly used the phrase turning a one-time sale into a lifetime relationship.
Because it's high-margin, recurring revenue that flows in every single month, whether you buy a new car or not.
Precisely. Think about the margins. The margin on a physical truck might be 10 or 15%.
Right, because you have to buy steel, glass, rubber, pay assembly workers.
Exactly. The margin on a software update that unlocks Blue Cruise, it can be 70 or 80%.
Wow, because the code is already written.
Exactly. Once the code is written, distributing it over the air to an extra 100,000 vehicles costs next to nothing. When you have 1.6 million paid subscriptions, you are building a massive software flywheel.
And the data itself is a moat, right? I mean, 840 million miles of Blue Cruise data. What does that actually mean for the technology?
It's the lifeblood for machine learning. You cannot program an autonomous vehicle using simple if-then statements. You have to train it on edge cases.
Like weird, unpredictable stuff on the road.
Right. What happens when a tumbleweed blows across a highway in Texas? What happens when a snowplow kicks up slush in Michigan and covers the lane lines?
You can't program a rule for a tumbleweed.
Exactly. Having 840 million miles of real-world, consumer-driven data allows Ford's neural networks to learn and refine the system at a massive scale.
A scale that a tiny startup with a fleet of 50 test cars could never match.
Never. And here is why this all matters for the bottom line. This high-margin recurring revenue is the absolute linchpin for Ford reaching its stated goal of an 8% overall company profit margin by 2029.
So they literally cannot reach their long-term profitability targets without software pulling its weight.
They cannot do it on metal alone. They need the software margins.
That makes total sense. If the physical hardware margin on that $30,000 UEV is super tight, you make it up by charging the owner $20 a month for Blue Cruise or premium connectivity.
Exactly. It's the razor and the blades model applied to cars.
But software isn't their only new frontier, and this next segment was honestly the wildest wild card in the entire earnings call.
Yeah, this part surprised a lot of analysts.
Let's look at Ford Energy and their defense adjacencies. So Ford is taking its electric vehicle battery technology and using it to build stationary energy storage for the power grid.
Yep, massive grid batteries.
Specifically, they are building 20-foot containerized LFP prismatic DC blocks. Now, before we go any further, translate that alphabet soup for me. What on earth is an LFP prismatic block?
Let's break it down because it sounds way more complicated than it is. LFP stands for lithium iron phosphate.
Okay. Iron and phosphate.
Right. It is a specific chemistry of battery. Most early electric cars, and like your cell phone, use lithium-ion batteries that contain nickel and cobalt.
And those are the materials that are really expensive and controversial to mine, right?
Yes. They are great because they pack a massive amount of energy into a very small light space.
Yeah.
But the downside, nickel and cobalt are incredibly expensive. They have super complex supply chains, and the batteries can degrade faster if you charge them to 100% every single day.
So what's the advantage of LFP?
LFP uses iron and phosphate. Incredibly cheap, totally abundant, conflict-free materials.
But there has to be a trade-off, right? Otherwise, everyone would just use them.
There is a trade-off. LFP batteries are heavier and physically larger for the same amount of power.
Ah, okay. So they take up more space and weigh more.
Right. But if you aren't putting the battery in a sports car where weight matters, if you are literally stuffing it into a 20-foot steel shipping container to sit completely stationary in a field next to a power plant, weight is entirely irrelevant.
That's brilliant. Who cares if the shipping container weighs an extra 2 tons? It's not moving.
Exactly. And the prismatic part of the name just refers to the physical shape. They are big, durable, rectangular bricks instead of little cylindrical cells like AA batteries.
Okay, so they are building massive shipping containers full of cheap, durable battery bricks. And the scale they are aiming for is massive.
They're going huge with this.
They are targeting 20 gigawatt hours of annual capacity by 2028. Management noted they are already in the third inning of selling out this future capacity to hyperscalers and utility providers.
And by hyperscalers, they mean the massive tech giants building out AI data centers. Companies like Amazon, Microsoft, Google.
Right, the AI boom needs power. Also, just on a related note of weird adjacencies, they briefly mentioned signing a contract to produce Super Duty prototypes for U.S. military use.
Yeah, they're tapping into defense contracts now, too.
But speaking as a retail investor looking at a car company, why on earth is Ford building massive battery blocks for the power grid? Shouldn't they just stick to building cars?
It definitely seems like a massive leap outside their core competency, but it is actually a brilliant synergy when you look at the mechanics of manufacturing.
Okay, explain the synergy.
The single biggest hurdle to the broader global energy transition, and specifically to powering all these incredibly energy-hungry new AI data centers, is grid-scale battery storage.
Right, because solar and wind are great, but the sun goes down and the wind stops blowing. You need massive batteries to store that power for the night.
Exactly. And there are dozens of startups out there trying to solve that exact problem.
So why can Ford beat those startups?
Because a traditional energy storage startup simply cannot match Ford's scale. By building batteries at a massive global automotive scale, Ford drives down what the industry calls the levelized cost of energy.
The levelized cost of energy, so it's basically economies of scale.
Exactly. Think about it. A startup buying materials to build 1,000 batteries has to pay a premium. Ford, buying materials to build millions of EV batteries, basically dictates the price of the raw materials globally.
Oh, wow. They have the ultimate purchasing power.
They have the purchasing power, the massive global manufacturing footprint, and the supply chain resilience of a century-old legacy automaker.
So they are taking the exact same LFP battery chemistry they're developing for that affordable $30,000 UEV, and they are essentially just copy-pasting it into shipping containers for the grid.
Precisely. It gives Ford a massive competitive moat against those small energy startups. And it creates a highly profitable, entirely new adjacency for the company.
And I'm assuming that helps the car business too, right?
It does. The beauty of it is that the profits from selling grid batteries to hyperscalers will directly subsidize their automotive EV investments. It lowers the cost per cell for their cars because they are producing at such a colossal volume overall.
Wow. Okay, so the sheer scale of the car business funds the scale of the grid batteries, which in turn makes the cars cheaper to build. That is a fascinating feedback loop.
It's a very elegant strategy if they can execute it.
So let's pull back for a second and look at how all of these disparate pieces, the profitable legacy trucks, the aluminum delays, the EV losses, the software subscriptions, and the grid batteries, how all of that impacts management's view of the rest of the year.
Let's get into the guidance.
Let's move to management guidance and the macro view. Looking ahead, despite that $1.3 billion net loss on paper from the battery joint venture write-down, Ford actually raised and narrowed its full-year EBIT guidance.
They bumped it up to between $10 and $11 billion.
That is a full $1 billion raise at the midpoint. They also bumped their adjusted free cash flow expectations to between $6 and $7 billion.
They are projecting a lot of confidence.
They are, and a big part of their confidence on the call seemed to stem from a massive company-wide crusade on quality control.
Yeah, quality has been a real sticking point for Ford historically.
It has, but they proudly announced that Ford just finished #1 among mainstream brands in J.D. Power's 2026 initial quality study.
Which is a huge turnaround for them.
And the material impact of this isn't just a fancy plastic award to put on a shelf, it is already showing up in the financials. Vehicle recalls are down 40% year over year.
40% fewer recalls is massive for their cost structure.
Exactly. Management stated they are targeting a massive $1 billion in material and warranty cost reductions in 2026 alone. But I want to dig into the actual mechanism here.
Sure.
How does an award for initial quality, which, correct me if I'm wrong, essentially just means the car didn't have any loose trim pieces or software glitches in the first 90 days of ownership?
Yeah, that's basically what initial quality measures, the first few months.
Right. So how does that 90-day metric actually translate to billions of dollars on the bottom line in the long run?
It's because initial quality is the crucial first step in a very specific financial mechanism. Management refers to it as a virtuous cycle.
A virtuous cycle. Okay, let's walk through how that cycle actually functions step by step.
So when a car doesn't exhibit problems in its first 90 days, meaning the factory assembly was incredibly precise, the software was fully debugged before shipping, the parts tolerances were tight, it is statistically far more likely to exhibit long-term durability over the next 5 to 10 years.
Right, that makes intuitive sense. If a car is a lemon, you usually know in the first few months. The transmission starts slipping immediately.
Exactly. Now that long-term durability directly and immediately lowers the massive payouts Ford has to make to its dealership network for warranty repairs.
Because dealers don't do warranty work for free.
No, not at all. Remember, when you take your Ford to the local dealer to fix a broken transmission under warranty, Ford Corporate is footing that entire bill. They pay the dealer for the parts and the labor.
So if you have fewer warranty claims, and specifically a 40% reduction in massive fleet-wide recalls, you are instantly saving hundreds of millions, if not billions of dollars in cash.
Instantly. It just stops the bleeding. But the virtuous cycle goes further than just cost savings.
How does it impact revenue?
Through the used car market.
Interesting.
Yeah, high quality and long-term durability boosts the residual resale value of the vehicle. If a 5-year-old Ford F-150 is known in the market to be completely bulletproof, a used car buyer will pay top dollar for it.
Because they know it won't break down on them.
Right. And when a vehicle brand holds its value better on the secondary market, consumers know this, and they're willing to pay more for it up front when it is brand new.
Because they factor in the resale value when they buy it. I'll get a lot for this when I trade it in.
Precisely. Furthermore, higher residual values make lease terms significantly cheaper to offer. All of this gives Ford much stronger pricing power on their new models.
So to summarize the cycle, better initial quality leads to fewer warranty payouts, which saves cash, while simultaneously boosting used car values, which justifies higher prices on new cars, bringing in more cash.
Exactly. It's a flywheel. Every single dollar saved on a warranty repair that didn't need to happen is a dollar they can funnel directly into the R&D for that $30,000 UEV, or the capital expenditures for the Ford Energy battery plants.
Fixing their historical quality issues literally funds their pivot to the future.
It does. Quality isn't just about PR. It's the financial engine funding their tech transition.
That is a brilliant breakdown of how a gritty factory floor metric impacts a Silicon Valley-style software pivot. Now, we also need to touch on the macroeconomic and geopolitical landscape, which naturally hangs over any global manufacturer.
The macro environment.
During the call, CEO Jim Farley made some specific comments regarding trade and the USMCA framework.
And just to be super clear for everyone listening, we are strictly looking at this from a business positioning standpoint.
Exactly. We are enforcing strict neutrality here. We are not taking any political sides or endorsing a specific trade policy. We are simply reporting what Ford's management stated as their strategy on the call.
Right. So looking purely at the business side, what does Farley say?
Well, Ford is aggressively pushing policymakers for a level playing field against Japanese and South Korean automotive imports. Farley cited on the call that these foreign competitors are currently benefiting from 40-year currency lows.
Meaning the yen and the won are very weak against the dollar.
Right, making their cars cheaper to export to the U.S. Furthermore, he noted they face only a modest 15% tariff entering the market, which he argues structurally disadvantages domestic manufacturers like Ford.
Because Ford has built out massive, highly paid local supply chains in North America.
Exactly. So from a purely strategic, operational standpoint, management is heavily focused on ensuring their North American manufacturing footprint isn't penalized by macroeconomic factors entirely outside their control, like foreign currency exchange rates.
And they went out of their way to note that Ford currently operates the largest manufacturing footprint in the U.S. auto industry.
Right. By making these comments on a public earnings call, they are clearly signaling to their institutional investors that they are not just passively accepting these headwinds.
No, they are actively engaging with lawmakers and trade policymakers to mitigate those external risks.
It's about protecting the fortress that generates the profits for their future investments.
Exactly. They have to protect Ford Blue and Ford Pro so they can afford to build Model E and Ford Energy.
Okay, so what does this all mean for the big picture? We've covered a massive amount of ground today.
We really have, from premium stakes to aluminum shortages to AI data centers.
So let's synthesize this entire deep dive and look at the bottom line for you, the listener. If you are trying to evaluate Ford's true trajectory right now amidst all this noise, let's summarize the bull case first.
Give me the optimistic view.
The bull case is that Ford has demonstrated exceptional, highly disciplined pricing power in their traditional internal combustion and hybrid trucks, extracting massive profits from smaller volumes.
The artificial scarcity model is working.
It's working flawlessly. They are also exhibiting massive growth in high-margin, recurring software subscriptions with Blue Cruise and Ford Pro Intelligence. Their staggering EV losses are finally beginning to shrink as they cut Generation 1 costs and prepare that highly anticipated, structurally cheaper $30,000 platform.
And don't forget the batteries.
Right. And perhaps most surprisingly, they have unlocked a brand new, highly lucrative revenue stream with Ford Energy battery storage, leveraging their massive scale to sell to tech giants. That's the bull case.
It's a strong case.
Yeah.
But we have to look at the bear case, too.
Yes, the pessimistic view.
Yeah.
The bear case is that Model E is still burning nearly $1 billion a single quarter, which is just an agonizing rate of cash destruction.
It's a massive bleed.
Severe supply chain vulnerabilities like that Novellus aluminum disruption that cost them nearly $1 billion in revenue remain a massive, ever-present threat to their most profitable commercial divisions.
One delayed part can halt the entire profit engine.
Exactly. And management explicitly noted that the second half of this year faces a projected $1.4 billion commodity headwind as raw material costs fluctuate.
So it's not all sunshine and rainbows. It is a company attempting one of the most difficult maneuvers in corporate history.
It really is like trying to change the engines on an airplane while you're flying it.
Exactly. They are managing a very delicate, highly precarious transition.
Yeah.
They have to ruthlessly maximize the cash cows of today, the V8 trucks and the commercial vans, while simultaneously funding the essential yet currently unprofitable technologies of tomorrow.
All while fending off traditional rivals, startup disruptors, and macroeconomic trade shifts.
It's a monumental task.
It is. Which leaves us with a final, slightly provocative thought for you to mull over as we wrap up today's analysis.
I love a good hypothetical.
Let's project forward. If Ford actually succeeds in this incredibly complex multi-front war, if they successfully launch a $30,000 UEV and embed Apple Maps natively across their entire fleet,
Okay.
if they successfully harvest and monetize 1 billion miles of autonomous driving data from Blue Cruise to create a true sauce flywheel, and if they become a leading provider of grid-scale lithium iron phosphate battery storage to the world's largest AI hyperscalers and utility companies?
Right, if all of that actually happens.
At what point does the label automaker become completely obsolete?
Oh, wow. That's a fascinating question.
5 years from now, will we be forced to evaluate Ford not against General Motors, Stellantis, or Toyota, but against tech, software, and infrastructure giants?
Are they competing with Chevy? Or are they competing with Amazon and Tesla?
Exactly. If the majority of your growth comes from software subscriptions and power grid infrastructure, are you still just a car company?
Probably not.
We'll let that hang in the air for your own future exploration. Thank you for joining us on this deep dive into the changing mechanics of the global economy. Until next time.